Phil Anderson of Economic Indicator Services discussing the relationship between the stock market and the property market. Brought to you by Prosper Australia.
There is one thing I should pass on, in the sense that you actually don't need to have opinions about whether the real estate cycle is past us or not, and whether we're going to get another asset bubble forever. And that is what you're seeing up there is a monthly chart of the Dow Jones index. The market will tell us whether this year whether we are at the end of the real estate cycle or not. And one of the things that I do for my subscribers is, you've probably noticed, most people are you're either in the real estate camp or you're in the stock market camp. Usually one or the other. So I try to show for people that are in real estate, I try to show them that to understand real estate better, you should understand the stock market a little better. The reason why you should do that is because the stock market leads. That tells you what's happening in real estate first. I try to tell stock market people you should understand a little bit about real estate, because if you have a look at history, every 18 years or so, every 18 to 20 years, the stock market absolutely tanks. And it tanks because the downturn involves land value, the capitalised rent. And if you can understand David Ricardo's law of rent, you then get to see a little bit about why that affects the stock market, because much of the stock market is built on the rent. The banks themselves, although they claim the interest, that is now also built on the rent. So 35% of Australia's index is banks, financial institutions. So every 18 or so years, real estate turns down, you get a stock market tanking. I don't need to really give those sorts of opinions, and if you want to know what's going to happen over the coming couple of years, you just need to look at the stock market, because the stock market will tell you. If you take the top, the US stock market topped in October of 2007. It then ran down until March of 2009. It ran down for approximately 17 months. It went back up for 9 months, and back up in price just a bit above half, which is always, in Dan's point of view, the 50% retracement where you expect the major news to come through to justify why it ran up like it did. Three things can happen now. The market could go sideways for a while, which it may do. The market may continue higher, or it may go lower. We're at a point where where I don't actually know what's going to happen. We're at a point where it's very difficult to forecast. 2006, 2007, it's easy to say in hindsight, but at the time on the website, this is all there, it was blindingly obvious we're at the top of a real estate cycle. Blindingly obvious. It's not so obvious now where we are. You don't need to know that, because the stock market will tell you. If the US stock market this year or next year makes lower lows than the 2009 low, that indicates more trouble for the US. That's the market telling you. It'll have to pay off more debt, or the banks are getting into some sort of trouble. If the stock market this year and next year stays higher than that 2009 low, and that's my position, then you have very much Gann's 18.6-year scenario in play. The US will be improving, and if that low of 2009 March doesn't break, it holds, then I can tell you that the GFC we've just seen, it's all over. People will forget it very quickly, and we move on. That's how you'll know.